Hello, everyone, and thank you for joining this Geneva Association Risk Conversations webinar titled Pandemic Risk, Is It Really Uninsurable? We'll be exploring the findings of our latest research report and investigation into the insurability of pandemic risk. We are enjoying an exceptionally large turnout today, and I want to thank in particular those of you in Asia in time zones east of us here in Switzerland, because it is quite late and we really appreciate your participation. My name is Pamela Korn, and I'm the Geneva Association's Director of Communications, and I'll be moderating our discussion today. I'm pleased now to introduce our speakers. Kai-Uwe Schanz is the report's author and the Geneva Association's Deputy Managing Director and Head of Research and Foresight. Arne Holzhausen is Senior Economist at Allianz and a member of the Geneva Association's Pandemic Risk Research Task Force. Kai and Arne will go over our findings on pandemic risk protection gaps. Hato, Schmeiser and Alexander Braun of St. Gallen's Institute of Insurance Economics are academic partners on our project, and they will talk about insurability, widely accepted criteria, where pandemic risk falls, and how it is different from other catastrophic risks. I will quickly provide some basic information on our virtual event platform. The second half of our webinar will be devoted to Q&A with you, the audience, and we encourage your participation either verbally by clicking the raise hand button, and I will unmute you so you can ask your question directly, or you can type your question into the chat box and I will read it out loud for you. Before we get started, I just want to make two brief points about our discussion today and the report on which it was based. As we see, the pandemic is impacting individuals and businesses enormously, but differently. In the insurance context, this means certain lines of business are linked to pandemic risks that affect individuals and others to those that affect businesses. Now, for the report, we focused on 3 pandemic risks in particular: health, mortality, and business interruption. First, the reasons are that first, their relevance for customers during COVID-19, and second, because of the availability of meaningful data, especially for mortality and health. The second point I'll make is that this is not the end of our research at the Geneva Association on pandemic risks. This report on insurability was intended to establish an evidence base for a follow-on report in the coming weeks on public and private sector solutions to pandemic risks. So with that, we can begin our conversation. Kai, maybe you can first take us through the report's key findings and conclusions, and then elaborate in particular on health and mortality protection gaps.
Thank you very much, Pamela. Hello, everyone, and particularly big thank you to all of our participants from Asia, where it is very late. It's a pleasure to address you today, and I would like, in order to set the stage, I would like to share the key findings of our most recent research paper up front. If we can move to the next slide. Obviously, COVID-19 has exposed massive protection gaps in business continuity risk. We measure the uninsured part of the loss in trillions rather than in billions, what we usually do for earthquakes and hurricanes. And the mismatch between the amount of or the magnitude of economic losses and our industry's risk-bearing capacity is illustrated in a very powerful way when you look at the business interruption segment of the insurance market, which is a niche area, a tiny area, and my colleague Arne Holzhausen will elaborate on this in a few minutes. So it is immediately clear that systemic pandemic business interruption risk is not insurable. It defies anything that we associate with insurability. The situation is different for life and health risks. Life and health risks in the pandemic environment are modelable based on the wealth of historical data. In addition, life insurers benefit from a natural hedge, if you like, between increased mortality and decreased longevity. Now, moving on to the next slide. Another key distinction that we have to make is between pandemic catastrophe risk on the one hand and other forms, more familiar types of catastrophe risk on the other. for example, terrorism or natural disasters risks. You know, systemic pandemic risk is not diversifiable, let alone insurable, whereas other forms of catastrophe risks are manageable through private sector insurance solutions. Now, moving to the next slide, a few conclusions. You know, or well, I think we have skipped this slide, but let me add a few conclusions in a nutshell. 3 key takeaways from what I've said so far. You know, number one, pandemic risk is a multifaceted phenomenon. It should not be measured by the same yardstick. Number two, there are clear showstoppers for pandemic BI risk, such as uncontrollable aggregation, such as uncontrollable correlation of risk. And third, so far, life and health insurers have coped with the onslaught of the pandemic. They have passed their baptism of fire, if you like, but still, one can easily conceive of much more aggressive future pathogens which might test this resilience that so far we have seen under COVID-19. So with that in mind, let me use maybe 3 more minutes to shine a spotlight on life and health risk. My fellow panelists will later on dig deeper into the business interruption aspect, but let me focus for a while on mortality risk. Mortality protection gaps are of significant relevance all over the world, especially in high growth markets. So you can think of the mortality protection gap, you know, as the financial shortfall a household is faced with in case the main breadwinner dies prematurely. And you know, this can add up to significant amounts, also measured as a share of GDP, especially in emerging Asia and Latin America. And this can become an issue when you know, significant protection gaps coincide with high levels of excess mortality due to COVID-19. Look at Peru and Ecuador, for example, countries which have seen the number of excess deaths doubling during the pandemic. So there is a double whammy, if you like, for households and individuals in these countries. Number one, significant protection gaps. Number two, a very high level of excess mortality. So protection gaps in these countries will make themselves or are making themselves felt in a very painful way. Now, moving on quickly in conclusion to the health side of things, the health protection gap in terms of magnitude is even more relevant than mortality protection gaps, exceeding 1% of GDP in emerging Asia, for example. You can think of the health protection gap as basically, or you know, it is proxied by the stressful amount of spending, out-of-pocket spending for healthcare expenditure. Now, if that coincides with an above-average vulnerability to severe courses of the disease, to severe courses of COVID-19, it can spell trouble. Look at the right-hand part of the slide and take a look at Russia. So the third couple of bars from the left, in Russia, you have a combination of very high levels of out-of-pocket spending, plus a very high likelihood of severe courses of COVID-19. And this is a very troublesome combination, which accentuates the protection gap in the Russian Federation. So the bottom line, and with that I conclude, is that despite the fact that life and health insurers so far have dealt successfully with COVID-19, there's no reason for complacency. Future pathogens might be more aggressive, might be more lethal. So the simple proposition here is that addressing the mortality and health protection gap should be a part of any national preparedness and resilience strategy for future pandemics. So with that, Pamela, I would like to stop.
Thank you, Kai. So you're saying pretty clearly that the insurability picture would change for a pandemic with more aggressive pathogens. So let's take the Spanish flu, which infected 500 million people, whereas COVID to date There are 52 million reported cases as of today. The Spanish flu caused 50 million deaths. Right now, with COVID-19, we're at 1.3 million. How would health and life insurers be impacted by a more lethal pandemic like the Spanish flu?
Well, first of all, I think, a repeat of the Spanish flu is an extremely unlikely scenario, but the reasons for that would be a different discussion. Coming back to your question, let me focus on the US, because the US is the only country for which we do have relevant data for what happened more than 100 years ago. And when you look at the level of excess mortality recorded 100 years ago in the US during the Spanish flu, and apply this to today's population of America, we would end up with more than 2 million deaths. More than 2 million deaths, which is almost 10 times the death toll of COVID-19 to date in the United States. So there is a significant differential in terms of mortality and fatality between what we are experiencing now and what could happen under a hypothetical Spanish flu scenario. Now, the relevant question, of course, is what would be the impact for life insurance? And according to a number of studies and calculations, number of studies suggested US life insurers would lose about 25% of their surplus, of their capital under a repeat Spanish flu scenario. 25%, a massive hit to the capital base, but still it would not bankrupt the industry. So the bottom line is that even under a highly unlikely Spanish flu scenario, the life insurance industry would not go under.
Thank you, Kai. That's fascinating. So we'll move on, please, to Arne, and you have some information for us on protection gaps in business interruption. Okay. We can't hear you. I think you might be muted, Arne. Are you muted?
Typical.
Great, no worries.
Sorry, now you can hear me hopefully. No, it's a real pleasure to be here because I think it's a very important work stream and webinar for the whole industry. So thanks, Pamela, thanks, Kai, for inviting me. I will talk you briefly through some numbers that hopefully convince you that this is enormous, really enormous challenge the industry is facing. I mean, Kai already mentioned it, the COVID-19 crisis is really exceptional. It's an unprecedented crisis in many aspects. And I would like to highlight here only one aspect, and this is the policy response. I mean, we know from the great financial crisis that central banks are able to cope rather quickly and boldly with any crisis, with any dislocations in markets. And they did it again this time around in March and April, flooding the system, flooding the markets with billions and trillions of additional liquidity to make sure that there will be no systemic event in the course of COVID-19. What is different, or what is and was different this time, that also the fiscal policy responded rather quickly and rather forcefully, because we have seen that around the world fiscal authorities put together measures from furlough, Kurzarbeiter schemes to direct financial help, from equity injections to loan guarantees, from tax breaks, name it. A lot of support rescue measures were immediately clubbed together to help people, to help companies to withstand the pandemic and the blow of the COVID-19 crisis. And by now, according to the latest fiscal monitor of the IMF, we have already these measures around the world already amounted to 10 trillions of euros. And you have to keep in mind that the fiscal monitor was published 1 month ago. And I think it's only included measures up to that were announced and implemented until September. So it's 2 months ago. In 2 months in the pandemic, it feels like an eternity. So we have now again this new lockdowns, and we have again announced new string and plethora of new measures. So still clearly the final bill will be much higher than this 10 trillion we already have here. And this is for, and then you have to keep also in mind, it's not enough yet, because we see rising unemployment and we will see an increase of wave insolvencies. Still there's this grace period for insolvencies, but next year everybody expects there will be much more, a higher number of insolvencies. So this is only to make sure that the this blow of the COVID-19 is not fully compensated but mitigated, and we still have more than 10 trillions of euros mobilized by the governments around the world. This is a good indication to give you a feeling for the size of the magnitude of the problem. And now move to the next slide. Now we look at what might the insurance industry might possibly can do about that. And for sure, the insurance industry is not a small industry, no way about. Last year, we had in premiums income of 1.5 trillion euros. This is quite a lot. But this is for the whole of the P&C insurance world. This is including motor, this is including property, this is including liability, and so on. The business interruption segment is a much smaller segment. I mean, it's hard to really quantify, but according to our best estimates, we think it's around 25 billion euros. This is less than 2% of the whole premium pool. And also, contrary to the perception in the media, or in some media at least, we paid a lot of claims. We're still paying and have already paid a lot of claims. I mean, true, COVID-19 is really difficult because there's low visibility on claims and losses, because it's not like a nat cat where you can see immediately the damages and have loss estimates available within days. This is more like an evolving crisis that affect and infect more and more parts of the economy, especially exposure to credit risk. The weaker economy is a big issue, but for sure there are also some shock losses, like cancellation of events, travel, and so on. And then, for sure, it also has to be mentioned, there's this issue of litigation. So this is not yet really visible how much will be the final bill for COVID-19 for the insurance industry. But what is clear to most observers is that we already have to pay out more than we have taken in premiums. So contrary to many perceptions, the industry is taking its fair burden, its fair share of the overall losses, of the overall outfall or fallout of the COVID-19 pandemic. But what's also clear, it's this gap to what is really to the real losses is immense. I mean, when we calculate the protection gap, then we come to numbers. This is close to 100%. It's because of 99%. So it's only a very, very small part is covered by the insurance industry, and that's why we can understand what's understandable that many clients and many policyholders are rather disaffected, that are disappointed. But if you compare the number, these are overwhelming numbers. It's simply not possible for the industry to cope with such a once in a lifetime loss event that COVID-19 represents. That's from my side to talk you to the numbers.
Great, thank you, Arne. So you're saying that in contrast to the report, which puts projected global economic out losses for 2020 at 4.5 trillion, this will undoubtedly go up. We're experiencing a new wave of the virus, a new wave of lockdowns, so losses will increase, economic losses will increase. Now, will the BI protection gap also increase? And will global insured BI losses also increase? So how does that work out? Does it work out proportionately, or do we have to think about other factors here?
Good question. For sure, it ain't over till it's over. So the honest answer would be we simply don't know, because this is an ongoing, evolving COVID-19 crisis. And despite the fact that we now have this announcement of a new vaccine, which was very, very good news in light of the end of the tunnel, it means that we have still to live for months, for several months with COVID-19. And that means also that we will have the stop and go measures, that we will see a lot of these kind of restrictions, reimposed restrictions, lifted restrictions, closed schools, closed restaurants, opened restaurants. This will go on for further on. That will create further losses for sure. And then we have, as I mentioned before, this wave of litigation. So some of the legal battles were won by the insurers, some of the legal battles were won by the policyholders. So the final outcome is also not really clear. But what is clear that the industry learned its lesson in the hard way, because all the renewals, all the new policies have much clearer exclusions. There's this crystal clear wording right now to exclude from new contracts the pandemic risk, because it's uninsurable. And that means that with the time being and with the involvement of the COVID-19 or pandemic, there will fewer and fewer policies outstanding where there's unclear wording, there's some doubt about the coverage. And that makes me quite comfortable, quite confident that with time being, the losses endured or endured by business interruption insurances will be less and less and will be smaller and smaller. There's no proportional correlation between this overall losses and insured losses. Thank you.
Thank you very much, Arne. So this sheds some light now on the protection gaps in health, in mortality, and in BI. And so we will now shift to the second part of our conversation on insurability. And I will ask you, Hato, to go into more detail on the framework that we put forward in the report. We put forward a very widely accepted framework of 9 insurability criteria, classified as either actuarial, market, or societal. Can you elaborate on these criteria and then how pandemic risks measure up?
Yes, so thank you very much. Indeed, I would argue that probably insurability is not really in exact science. So there are quite very different aspects that have been mentioned in the literature. Clearly, I think if we look on the supply side, it very much also depends on the insurance perspective and their major goals. They are willing to risk bearing, risk assessment, general, also economic goals, and also the demand side, which typically would depend very much on risk aversion and other aspects. And there are 9 criteria, as you mentioned, that had been set up in the literature. And we can go through them a bit and say, okay, what can we say about COVID-19? Some of the aspects actually had already been mentioned by Arne and Kai-Uwe, which are very important when we think of general pandemic and high correlated risks. But I would also like to mention that probably we need more to focus on could supply and demand side come together if we look at specific lines of businesses. And I think there are probably some where it works much better than others, but it very much depends on, let's put it this way, the systematic risk, which is still there and cannot be diversified. But Pamela, to come back to your point at the very end, okay, what are the 9 criteria? And indeed, we would be, and that is the point we made in our study, is we would be rather negative about the actuarial aspects that are covered by the first 3 points. So the major point is certainly the stochastic dependencies that we face when it comes to such a risk. Yeah, so there are very few exposure units which are probably not hit, and so you have almost no diversible risk. So the so-called unsystematic part is rather small, and that is in a way destroying the general idea of insurance, and that makes it so difficult. Also, to put it that way, it is also not that easy to put a maximum possible loss, yes, to put some upper limit into this insurance or insurance of risks that come out of COVID-19. And I think you can only put that in particular contracts where you set up a particular insured sum. That's the only way you can do it, but that may not cover clearly the whole loss that some particular person may have. But that's the only way, in a way, to get some limitations. I think when it comes to information asymmetries, I'm not that negative. There are some clearly that pop up when it comes to adverse selection effects and also moral hazard. If you think of moral hazard, I would also argue that we have issues that could play a role, that incentives to risk avoidance and similar aspects, that they are reduced maybe if you have some kind of full coverage. But I think we contract features, you could somehow get away of that one. Clearly, the other aspects, and that's the major point, is the pricing, insurance premium, and that is the only, when you come back to these 9 aspects, which are more in line with bringing the supply and demand side together, because there must be an insurance price that is not just fair from the supplier side, there must be some demand out of it. Yeah, and that could be very critical. And I will come back later to that one again when we try to get not only the supply side, but the demand side into the game. The other aspects, cover limits, yes, they could be very complex when it comes in particular to certain areas of non-life. Yeah? And some legal restrictions, public policy that also play a role into it. But here I would be more positive, because you could have, and we had that already in this crisis, criteria that say, okay, if you need to close your business, for example, by law, then this could be a trigger point. Yeah, and if not, then you may have losses that may be clear, but they are not insured. And so I think that could work. Yeah? Maybe before I try to get the supply and demand side together, maybe a quick remark to the next slide. So we also commented on different lines of business and say, okay, when could we rather think of getting coverages, and where are the areas which are more problematic and difficult? And we already see it in the market. Maybe you could argue that's not very surprising, but health insurance actually works quite well. So we had, even so this is a very severe case, that is quite stable. So that is a good news. Mortality, and let's say in general life, why? That also works quite well. First of all, we have very good data when it comes to changes in mortality and so on. And also, and I think that works quite well here, a bit of diversification plays a role, because we have annuities, we have term life, and so they work in different directions, which helps life insurance companies to diversify the underlying risk, at least to some extent. But, and here I can come back a bit to the points that the colleagues mentioned earlier, when we go into business interruption, which is a very important part. And there's in general large demand for that one. It gets very difficult. Not just the dependent structure, but also the limitations, the upper limits are very difficult. The definition of risk triggers are difficult, and so on. And we've seen that. And it is actually, the industry is very much and was very much aware of these factors, but it's still difficult to handle it if you have more or less 0-1 cases, so you have a loss to the whole industry or nothing. And let me do the last point that I want to do, because these criteria, we mentioned that in the report, that originally go back to Berliner and Carton. I would say they are helpful, but each of these points you could argue, well, you find cases which don't fit in, and that is right. Yeah. And so I would not fully stick to the line of reasoning that had been made in the literature saying if one of these points does not hold true, you cannot offer insurance. I would say that's too strict. But I think if it comes back to COVID-19, we can sum it up, and the insurability of pandemic risk, I think we can sum it up quite easily and say, well, if the supply and demand side come together, it works. Yeah. And what are the loadings and in a way trigger points? From the demand side, clearly the risk itself and expected claims plays a role, but here the risk aversion is important. So clearly people who are more risk averse have a higher willingness to pay. But if they are rational, their willingness to pay for pandemic risk is actually high. Why? Because we face a typical interrelation to your stochastic basic income, because typically whenever you have claims out of such a pandemic risk, because for example you need to close your business or you're losing contracts which are important for your income and your business, so you have losses on that side and you're losing income. Yeah, and so that should actually trigger your willingness to pay. That should be high. The problem is that from the supply side, the price is also very high for two reasons. The one is you have this high correlation within the portfolio that from the actuarial side, we mentioned that before, leads always to a loading. That is systematic, so you can't diversify that within the pool. But the even more severe part is that you have strong interactions in such a scenario to the capital market. So it means, so if you have a lot of losses to pay out as an insurer, the capital market may be down, and we've seen that. You can argue, well, now the stock market looks quite good, that's right, but we should not forget that we put quite a lot of money into the system. So probably things would be more severe if we did not have gone along this path. Yeah, and so you have that strong systematic risk, which you typically don't have when it comes to insurance. And I think that makes it difficult. And then if supply and demand can come together, that's a difficult question.
Thank you very much, Hato. I think we see that all of these factors come together to, and this is a point that's underlined in the report, to make pandemic risk uninsurable because of this correlation factor, and the amount of losses that it would entail would make the cost of policies so high it would be cost prohibitive. And this is something that the report addresses. I just want to quickly mention to the audience that we will ask Alex to make some comments, and then we will open it up for Q&A. So if you want to begin raising your hands or typing in your questions, we will start to get to that. But for now, Alex, please, Hato mentioned time and time again that what is unique about pandemic risk is the systemic factor. So I think that this is a very nice entry point for you to talk about how pandemic risks are different than other extreme events, other catastrophic risks.
Yeah, thank you, Pamela, and welcome from my side. So I'm happy to wrap this up with a few comments on how pandemic risk compares to other extreme events such as natural disasters. And if you could go to the first slide. What I've done here is I have summarized some of the dimensions, let's say, that we reported in the study, along which you can actually compare these different types of extreme event risks, and you can see along the x-axis or the horizontal axis different categories, different types of extreme event risks, you know, ranging from pandemics over wars, nuclear disasters, all the way to NatCat. And there are far more dimensions in the study. I've just picked the three main ones, and I think they nicely correspond to what the previous speakers have already mentioned and pointed out, because particularly at the bottom, we see that the dependence of the individual risks is extremely high. So you have virtually a global correlation of risk, which is significantly different from most of or all of the other extreme event scenarios that you see in the table, particularly natural disaster risk. I can comment on that on the next slide and show it more graphically or visually to underline the point. But really here we have a risk of a very specific nature, in the sense that all countries globally, all companies and so forth are correlated. Two other criteria are the severity. So we have heard and the measurability of risk. So regarding severity, we have seen and heard the figures that Arne reported, which were you know, extremely high. So essentially several times the capital base of the global property and casualty insurance industry. So we have a size of the loss, if you want, that is also several times higher than what you see in a typical natural disaster scenario, such as, you know, US hurricanes or Japanese earthquakes. And then the measurability, that's the third dimension. So we're going bottom up here, is also very different to particularly the NatCat dimension. Because in natural disaster risk, we have very reliable models these days that allow us to quantify the risk, although we do not have extensive historical data on the very tail events. But with pandemic risks and also some of those other more man-made risks, the problem is that in addition to the science, you know, the laws of nature that allow us to model natural disaster risk on a very reliable scale, in addition to those scientific rules, we have human behavior that is part of the risk. We have responses, reactions, we have global travel, and we have you know, lockdowns and things that are induced by man, which make it very much different from a natural disaster scenario. And given we had a massive lockdown in this pandemic, doesn't mean necessarily that in the next pandemic scenario we'll have the same type of lockdown. So things could play out very much differently in another pandemic scenario, and that makes it very, very hard to quantify and measure the risk. So I think these are the three main factors that differentiate pandemic, particularly pandemic business interruption risk, from our classical NatCat scenario, and also from some of those other extreme events that we discuss in the study. Now, just if you could go one slide forward, this is the point I wanted to make with regard to the diversification, that is possible on a global scale with natural disasters. Although natural disasters cause a regional correlation of the risk, let's say you are an insurer in the southeast of the United States, you have very much a portfolio concentration there, and a hurricane hits, then your portfolio will face highly correlated risks there. But you can, through reinsurance and classical tools, really diversify that on a global scale by sort of merging it in a portfolio with disasters from other regions around the world. And that works sufficiently well so that the risk becomes insurable and becomes manageable. If you go to the next slide, that is different in a global pandemic, which also is different from an epidemic, as we've seen, back in the day with the SARS-CoV-1 epidemic in Southeast Asia, for example, which was regionally concentrated, and therefore it didn't have the same economic impact on a global scale. But this new scenario that we're seeing now, the COVID-19 pandemic, is really triggering losses all around the world. And this is where, you're looking at a cataclysmic scenario, and there's nothing you can do anymore. So there's no way to diversify this. And I think one point that Hato mentioned that it's really important here is not just correlation about among the individual risks in an insurance portfolio. It's also correlation between your insurance portfolio and typical capital markets assets. And that plays a major role if we go to the next slide, if we think about solutions. So on this slide, you see a few, different ways or pathways to deal with different types of risks. And on the y-axis, we have the geographical scope of the risk, and on the x-axis, there are different, different tools, different means to deal with the risk. So insurance and reinsurance on the very left side really works for both locally diversifiable and globally diversifiable risks. So let's say you have your typical auto insurance portfolio. There's no correlation among the individual risks, so it's highly insurable. Insurance itself works well. If the risk correlates on a regional scale, such as natural disaster events, we have the hurricane here as an example, then you can still go through reinsurance and insure it on a global scale. If you go, if you go one step further to the right, alternative capital is still an avenue. So insurance-linked securities and all the new mechanisms that we have to transfer risk to capital markets, those work well as long as the risk is not correlated to the capital market as well. So we talk about globally diversifiable risk. It may be uninsurable on the global scale, but as long as the capital market investors doesn't have losses at the same time that this insurance risk materializes, it can still be dealt with through alternative capital. And this breaks down in the context of a major pandemic such as COVID-19. So here we're talking globally undiversified, also in a capital markets portfolio context. So even if you securitize the risk and pass it on to investors, they will face losses on their securitized insurance risk and on the rest of their asset portfolio as well. So we have to think about new solutions in the context of public-private partnerships and see who can actually bear risks, but without involvement of the sovereign and of a backing from states, it will hardly be possible to actually deal with this risk in the private sector alone.
Thank you very much, Alex. So we can now turn to our Q&A portion of the event, and we have a few written questions here. The first is for Hato. This comes from Thomas Kohler. He has two questions on insurability. Do insurers have the possibility to diversify portfolios and limit their exposure by geographical diversification and limitation of guarantee? So we've just touched on this. Wouldn't it be possible to start working on such coverage very limited and increase the capacities over the years? That's the first part, which I think Alex has done a good job of already starting on. And second, I see the point of the correlation with the capital market and the high level of claims to be paid. And then it gets cut up, but he says, but COVID was down 2 months. This is the question. But perhaps there's something in there that you can dig into, Hato. unmute.
I need to unmute, sorry. Thank you very much for the question. That is a very, very important point. So could you not just do more on the time level? Yeah. So of course, diversification not only works in a way that you try to get many units, yeah, and that are hopefully mostly independent. It also works on the time scale, and that is right. And if you look back, and that is a bit what we currently do in a research paper, where we say, okay, we had also other pandemics that could fit into something which is insurable, which is more locally done. And so you could say, well, from the point of view of, let's say, large players in the field and large reinsurance companies, they could easily try to use that and diversify globally. And that would be a little bit stick to what Alex mentioned in the last slide when he talked about global diversification. And indeed, we had quite a lot of cases where risks indeed were rather separated and in more local areas. And that would very much help to diversify them, at least on the long run. You could argue that if you have then something like COVID-19, you may still have not enough resources that will be able to pay out, but it still helps if we find insurance coverage for local pandemic risk, and if we have, of course, many years in between where we have more or less nothing. Yeah. So yes, that would be helpful, but you still, and this is the point Arne made, you still need very proper definitions of what you can do in cases where you indeed have high correlated payouts. Yeah. And in a way that also, the second point also holds true for the capital market interrelation. You can very well argue, what is the right scale there? Yeah, and you could argue that if you have high payouts in, let's say, 2 months, and maybe you have that breakdown on the capital market on the assets, if maybe on the long run, yeah, if you have some kind of more or less also, we could also think of rather compulsory scheme on the long run, it could still work, yeah, because on the long run, it would be on the underwriting side okay, and maybe also on the capital market side. But still, you have the hit of the big case, and that is so systematic that you need to avoid that the payouts finally break you down. That's a major issue. But you're right, that's an important issue, thinking of the time frame. Yeah.
Thank you very much, Hato. So I have Carlos Orocha, who is raising his hand, and I will attempt here to unmute him and hope it works. Carlos, are you with us? You may have to unmute yourself, Carlos. If not, I have a good question here backed up. Let's see. Okay, we'll move to a different question.
Oh, can you hear me now?
We can, yes, wonderful, welcome.
Okay, thank you. The question is for Mr. Holzhausen. He said that the BI global premium was 25 billion euros and losses of 35 billion for a loss ratio of certainly less than 150%. How could it take 150 years to recover for that? Or am I missing something here?
Arne, I think this one will be for you.
First, let me unmute. No, I mean, first of all these numbers have to be taken with a big pinch of salt. These are estimates. And as I mentioned before, the visibility of all the losses are quite low. And even it is hard, I mean, if you have tried to work with insurance data, it's even hard to establish real clear numbers for different segments because each country jurisdiction has different classifications. And so to come up with a global number is quite, yeah, it's good guesstimates, and we are confident that we are not too off the mark, but nonetheless take it with a pinch of salt, please. And this 150 do not reply to the business interruption claims, but it's to the overall losses. What would be the case, how many years we would need if the insurance industry had to cover all the losses, what some people claim should be the case, then it would be 150 years. If we stick to the narrow definition of business interruption losses, and many of them are undistributable, don't forget, I mean, we paid out a lot of millions of euros and dollars for cancellation of events, for example, Olympic Games and all the sport events. This was not disputed, and this for sure will not take 150 years, because this was in the scope of the coverage. We're talking here about claims that would arise which out of the scope of business interruption, but really then attends or applies to all the overall welfare losses we face in the COVID-19 crisis.
Okay, thank you.
Thank you.
Thank you, Carlos, and thank you, Arne. We have a written question here from Lee Wolfram, and I think this one would be for Alex. I have often heard comparisons between cyber and pandemics, where WannaCry or NotPetya cyber attacks would be the equivalent of an epidemic like SARS or MERS, while the cyber version of COVID-19 has not yet occurred. Could you expand on what would make cyber insurable but not infectious diseases?
Yeah, thanks a lot for that question. I think that's a very good one. And, cyber risk, considering potential virus in the cyberspace is really something that could be comparable to a pandemic scenario. But we're doing a lot of research here at the Institute on cyber risk as well. Our colleague Martin Ehling is very involved in that area. And what we found out is when you look at it more closely, that there are hardly any cyber risk scenarios you could come up with that could take the magnitude of the current COVID-19 pandemic. So cyber risk is clearly a risk that has a major accumulation, loss accumulation potential. And so it's one of those extreme event risks that you need to deal with in some shape or form through alternative risk transfer. But the most severe cyber risk scenarios you could think of are, major blackout scenarios or takedowns of the communications infrastructure of countries. And it's very hard to imagine that something like this could happen on a global scale. So it is a theoretical possibility, but I would say it's very, very, very rare. Whereas what you could see is, a potential takedown of the internet or communications or energy supply in a whole area. Let's say major parts of Europe or the United States, which would certainly cause substantial losses to the industry if you were to insure that. But that is something that still should be globally diversifiable in a capital market portfolio to a certain extent. If you come up with that very, very rare scenario of a global cyber incident, which I think is not really likely, then you would have the same problem with the COVID-19.
Sorry, if I may skip in here, I think also one of the differences is that the cyber incident can be quickly fixed, or hopefully quicker fixed than, say, a pandemic. I mean, now we are so happy that after 1 year, we are close to a vaccine. Hopefully it would be much faster to find some kind of defense against cyber attacks. So that would be hopefully not last for 1 year or even longer. Now for the pandemic, realistically, we have to assume that 2 years we have to live with the virus. Yeah. This is certainly hopefully not the case. I mean, theoretically maybe, but practically hopefully not, I would say.
That's a very good point. So the duration of the loss occurrence should be shorter. And the reason why you would probably assume that it's very hard to think about this on the global scale is that one single virus or one hack can probably not effectively affect all systems worldwide. There will be different security measures in place. Systems will be disconnected. There will be backup systems in place. But that's not true for humans, right? So if you have one special pathogen as the coronavirus, it can affect virtually any human being worldwide. So there is no defense measure that can protect us apart from social distancing.
Right. So again, the diversifying factor comes up, and we're also hearing that the solution hopefully would be a lot more speedy. For the next question from Tim Hardy, he says, conclusions about insurability assume the conventional approach of pandemic risk causing material damage leading to BI losses. Any considerations given to subspecies of losses of more confined prescribed types which might alleviate protection gaps in any areas. So Arna, this might be for you or whomever wishes to chime in here.
Yeah, thank you. I would like to give the question also to Kai, because I think he already mentioned one of these subsectors where we can handle this virus. This is health and mortality, where we probably have less of the problems than say in the business interruption. So over to you, Kai.
Yeah, absolutely. I think there are areas where pandemic risk had been anticipated. All life and health insurers had pandemic risk on their agenda, did model for it. What nobody, it's not the black swan. What nobody had on the agenda was the policy response. This is the black swan, not the pandemic as such. And as Arne said, we have areas where this was on the radar. You mentioned Arne, event cancellation, life health, other areas. The big surprise was business interruption generated, losses generated by an unforeseen, globally coordinated and synchronized policy response. This is how I would put it. And that's clearly, this is the most systematic risk you can imagine, and it clearly defies anything we can do as an industry.
Maybe one thing I would add is even when it comes to business interruption risk, we can insure it as long as it's an epidemic. So as long as it's confined to a certain region in the world. And this is why, during the discussion in the lockdown in spring, we had a lot of complaints about the differentiation between the terms epidemic and pandemic. But this is really what it comes down to when you talk about the diversification or insurability of risk. So this was not a legal gimmick. This was a very important distinction, and which is why I think going forward, if you were to offer business interruption policies, you would take strict limits and you would make sure that as soon as it becomes a pandemic, if you're a globally operating insurance company, you cannot handle it anymore, and therefore it needs to be excluded. So locally confined epidemics can be insured, pandemics on a global scale cannot be.
And maybe when I come back to this, the question, indeed, the point is all the time frame. So it seems to last much longer than we first thought, and that makes it complex, because if you have a traditional insurance contract, let's say also on the retail market, and you have particular upper limits, so the question pops up if you can hit them, let's say every month or every half year or every year. And I in particular heard from the reinsurance sector that this is quite an issue, yeah, and that can be more severe if you have such a scenario for many years, yeah, and not just maybe for 1 year. And of course, all the other points are very important that you mentioned, the global aspect, which makes it difficult. I think that's but what's absolutely right, what Kai-Uwe said, we had, if you look at standard solvency tests, of course, they have this risk source in it. And so it is not per se new. We had that certainly on the screen. It's more the severity, which and the global scale and the long time that it lasts now, which make it so complex. Yeah.
Thank you, everyone. I think we have time for one more question, and then we'll have final remarks. So from Mark Horowitz from the European Commission asks, sticking with the diversifiability theme, while it is claimed to be impossible to diversify pandemic risk, isn't there a possibility to diversify the risk by bundling it with other risks, like precisely cyber risk or terror risk?
Well, I think that the problem is that we, if I may jump in, that we would need an institution that has enough capital to build a portfolio of those individual types of risks. And given the numbers that Arne has shown us, it will be very hard, right? So you can take a slice potentially of business interruption risk, but then you would need to put strict limits on, and this was a point that Hato mentioned, on the duration that you can, actually afford to pay. And this is the only way you would be able, with any realistic capital base, to insure it. I mean, still, it's a good point that there are certain types of insurance risks that should be uncorrelated. So, natural disaster in a portfolio of pandemic risk and with cyber risk and all those risks, there is no reason to believe ex ante that there should be a systematic source driving all of these risks at the same time. So correlation should be low, but then it comes down to the magnitude of the risk again. So the severity dimension that we discussed, which differentiates it also from natural disasters and usual cyber. Even the mid to large size cyber incidents should be much smaller in terms of losses than what we see here. So I think the combination of all the elements that we discussed, so the duration of the exposure and the losses, the correlation and the measurability, and all these things together make it really hard to handle. Otherwise, I think it's a realistic approach to say you should bundle it in a portfolio with other insurance type risks with which it is uncorrelated.
Yeah,
I would make the point that it actually doesn't work because in the extreme case, because clearly insurance will work in the way that you say, okay, the amount of money that I would need for some safety level will get smaller and smaller if the portfolio gets larger. So that would be the main idea. And so that the individual resources that are needed to cover the risk on a specific safety level, that this goes down if n goes to infinity. So that's more or less the idea. And here, if that is true, that it is pure systematic, then it doesn't change. So whatever you do. So in a way, the insurance part doesn't work, and you could put it in a way as a loading on another insurance. Yeah, you could argue, and that is, I can see this point, but however, it is more like you could also simply say, well, we set up some taxes for covering it and put these taxes as a loading on insurance for other areas. My major point is that the insurance, let's say, advantage for the policyholder would not work anymore if it is really systematic. And so, yes, you could do that, but it is more than putting resources into it that you can cover it. That's a valid idea, so I agree. But you can even simply set up taxes and do that, or some other way how you finance it. The insurance business model, in a way, doesn't support it anymore, doesn't put additional advantages for the policyholder. Yeah? It's just a funding version that you do there, but it's not based on diversification in the severe case. If there's still diversification working, yeah, then I agree. Yeah.
Kai, anything to add there?
Well, I think we will cover some of these aspects in our forthcoming publication. Where we have a section which discusses the virtues of bundling various catastrophe risks. But there seems to be a sort of disconnect between the mainstream academic view and what's going on in the practical arena. I think in the UK we have discussions around the systemic re approach. We have pool re, trying to venture into other catastrophe risk and trying to make a case for this. So that's the question that the gentleman from the European Commission asked is highly relevant. But apparently, the academic community seems to be less inclined to pursue this than some of the practitioners.
Great, thank you, Kai. Arne, any last comments from you? We will give everyone the opportunity. We are nearing the end here, but if you'd like to make any final comments, Arne?
Yeah, well, final comment. I think also for us as an industry was a steep learning experience, a steep learning curve. And as Kai already mentioned, I think the problem here is that for us, pandemic is not a black swan. Had it long on the radar, and if you look at our publications in the last couple of years, it was always popping up as a very important topic. What we really have to do better, and that we learned the hard way, that we have to be much clearer, much more transparent, what we can cover and what we not cover, and we have to be a crystal clear wording here. And even if it's only a niche product, a small policyholder, we have to take care of everything. And this is something that the industry should take to heart, that we have to do even better here to be on the side of our clients and to be very clear from the beginning what we can do, but also very clear what we cannot do to avoid any confusion later.
Thank you, Arne. So this goes back to something we talked about earlier with insurers already having to revisit their policies, revisit exclusions, and so this is certainly changing their approach and changing the business. Alex, any last comments from you?
Yeah, I think I like what Kai said regarding the black swan, and also what Arne said. I think for the insurance industry, it was clearly not a black swan, but it was a black swan from the perspective of other observers, particularly if you look at our policy responses around the world. It seems like our politicians did not have contingency plans in place to deal with this kind of scenario, because some of the losses we faced, particularly during the spring lockdown, were owed to the fact that the reaction around the world was quite late. So if you turn to China, they handled it quite well, and other countries in Southeast Asia, such as Singapore, because they had experience with events like this, considering the SARS-CoV-1 epidemic in the early 2000s. So for these countries, it wasn't a black swan. For our Western economies, it seems to have been one, because we're very slow to react in terms of policy response. And I think that is a key takeaway. Not only the insurance industry, but also in the policy makers and institutions have to prepare next time, to make sure that the economic loss, not just the insured loss, the economic loss is lower than what we're facing today.
And it's the economic losses which were not able to be modeled. Another point that we underscore in the paper. And Hato, any last comments from you? I think he's muted. No, he shouldn't be. Or we can go to, okay, there you are.
Okay, thank you. Okay, indeed, maybe quick remark. I think the point Alex mentioned is indeed very important to say, okay, what are optimal risk management measures? And I think the industry, so from, let's say, the government point of view, and I think the industry can actually also help there and do a good job, because risk management is their major task. And they know that this depends so much on the quality of data. And we can improve that, because data would be very important in order to find out, okay, how is this pandemic really going to the society? Currently, it's very difficult to say. We know who are actually tested positive, but actually how does the infection in a way develop in society, to get there more information and find out, okay, in which situation, if we have a new pandemic, is it better maybe not to close down anything? When it's better maybe to secure mainly the persons who are in risk, or maybe in which situations are complete lockdown the best version, taking health but also other factors into account. And I think that will be an important task. I think the industry can do a good job, because it helps actually the society in that respect, because that's the core issue for all of us.
Thank you, Hato. And Kai, please, you can close us out here.
If I may, one final remark. I think we all agree that pandemic BI risk is a new challenge, a fundamentally new challenge. We have hit our limits in terms of trying to expand the limits of insurability, something that the industry has always endeavored to do. And the key challenge from a very, very high level is, in my personal view, at the end of the day, our response will shape the society's perception of how relevant we are as an industry. This is a systemic shock. Just stepping aside is probably not an option. Our stakeholders will expect us to play a role. On the other hand, we have to make sure that we maintain our solvency and our financial viability. This is an extremely difficult and delicate balancing act, and one of the key challenges, in my personal view, for the industry going forward.
Thank you, Kai, and thank you to all of our presenters and to our large and attentive audience. I think we talked we hinted at a lot of possible insurance solutions to pandemic risks, and I think we broke it down in a pretty nuanced way. And we look forward to all kind of coming back together again in, let's say, early in the new year, to talk about what we see as the feasible solutions, public-private partnerships. So thank you, everyone, and we wish you well and good health.
you. Bye-bye.
Thank you. Bye-bye. Thank you.
Thank you. Goodbye.